Hi there, everyone. Thank you for taking time to listen to our presentation. So we've had a positive performance in the quarter, but it was largely driven by FX gains and through sterling weakness against the dollar. So the portfolio increased by 21 million to 207 million. So we reacted swiftly to the first sign of the economic downturn in early 2022, and investment levels have been very consistent over the last 3 quarters, with less than £10 million deployed each quarter. We've continued to make a handful of both new and follow-on investments in each quarter, and a number of exciting new investments have joined and enhanced the portfolio this quarter. We remain heavily focused on supporting the existing portfolio, and with 44 million cash in hand and a well-capitalized portfolio, we consider that we're well positioned to support the portfolio into 2024. The cadence of high-quality new investment opportunities we're receiving remains high. We expect to continue to expand the portfolio with selected opportunities that are mainly going to be focused around climate and insurance, because these are the types of areas that we're currently focused upon. We've also opened offices in San Francisco during the quarter. We're trading under the name Generation Space in the US market, and we've commenced a new space accelerator program which runs in parallel to the EU program, which is run out of the UK. So that means that there are plenty more potential options over businesses for the trust to invest into. So let's start with the financial highlights. So on the 30th of September, the share price was at 60 pence, a massive 52% discount to the 105 pence NAV per share. So this high level of discount is not Seraphim specific. As you can see in the chart on the right hand side, this shows SSIT versus our AIC peer group of private growth capital trusts. SSIT is the green line and showing the share price performance, and you can see the correlation with the NAV performance with the group average as well. Market capitalization was 145 million, which was up from 127 million last quarter. The portfolio is valued at 207 million with net assets of 250 million, which includes 43 million of cash. Now, this trust doesn't have a specific benchmark, but as can be seen in the charts on the left-hand side, performance is aligned with the rebased FTSE All Share and the NASDAQ, which is sterling adjusted, where you can see material underperformance during the period. We also include benchmarks of the MSCI Defence Index and the MSCI World Climate Indices to demonstrate the performance of those sectors, considered to be the most relevant, given that over 90% of the revenues from our top 10 private companies comes from defence and climate related customers. So this table looks at the attribution analysis. This is the movement in the value of the investments. The value of the portfolio increased from 186.1 million to 207 million during the period. A total of 8.9 million of additional capital was deployed, and this was evenly split 4.4 million into new investments and 4.4 million into follow-on investments. The underlying fair value actually fell by 1.7 million, but this was offset by 13.8 million in FX gains from continued sterling weakness against the dollar. So this resulted in a net fair value gain of £12.1 million. So this table shows the NAV bridge over the period. The NAV increased to 250.3 million from 239.3 million opening position. Besides the 12.1 million increase in fair value of the portfolio, other contributing factors were the management fees and expenses, which were 1.1 million. The NAV per share increased during the period from £1 to £1.05. So this table looks at the investment activity during the quarter. We've continued with a similar cadence of deployment versus previous quarters, 7 transactions with 3 new investments, 8.9 million deployed. And the picture here is of a plant leaf with a disease, which can incredibly be identified from space by one of our new companies, Taranis. So let's run through these new investments, starting off with Voyager. So this is an exciting new addition to our portfolio. It's unusual to the rest of the businesses. This business is looking to become a next generation space prime. The business is different to the rest of the portfolio because it's a buy and build strategy. Since 2018, when they were created, this business has already acquired 6 companies. They're now generating more than 100 million in revenues. That's in dollars. They're working alongside Lockheed Martin, where Voyager is one of 4 consortiums that have secured very significant funding from NASA to fund the development of commercial space stations. This is now a pressing need, given that the ISS, the International Space Station, is approaching the end of its life, and the Russians have also threatened to withdraw from that. Voyager has designed and has developed Starlab, which you can see a picture of, a next generation free-flying private space station. So Starlab provides the facilities to host public and private astronauts, as well as forming critical infrastructure required to support research and development, and in particular, manufacturing in space. That's our core interest of why we've invested into Voyager as the next generation in-space manufacturing capability. Seraphim completed a $2.5 million investment into Voyager's B series round in July. And with this B series investment, Voyager seeks to continue to finance the development of Starlab and continue to expand their capabilities through strategic M&A. So the other company is Taranis. So this is an agriculture analytics business. So they undertake sub-centimeter analysis of individual leaves within farmers' fields to identify early signs of disease, pestilence, or lack of water, lack of nutrition. They do this through drones, and they collect this data, and then this data center is then used to train the algorithms to be able to assess data that's collected by satellites. Rather than selling to the farmers, their business model is very clever. They sell to the companies that provide products to farmers, such as pesticides, effectively providing them with the business development data so they can target farmers with specific needs. This helps drive the more efficient use of pesticides while also helping improve crop yields. This company is playing an important key theme of food security, but is also targeting the carbon credit validation market, which they consider to be a huge growth area. In August 22, Seraphim completed a 2.5 million investment in Taranis' D series. Taranis received this investment from numerous top investors in Israel and other growth investors. And with this round, Taranis will build out their US sales capability and gain early traction in this area of their new carbon monitoring product. This next company is a follow-on investment into an existing portfolio company. So Planet Watchers is a software company that uses radar satellite data to provide global scale information to the crop insurance industry. So in the US, the crop insurance industry is a regulated industry where 13 companies offer crop insurance against climate-related extreme weather events, such as hurricanes and flooding. In the event of a weather event, Planet Watchers are able to capture the damage to individual crops in specific fields, and this information is then used as a source of truth for the insurance companies to assess claims and to make payouts. This is a huge cost saving to the insurers, as they don't need to send loss adjusters to the field, and it also eliminates fraudulent claims. So in August 22, Seraphim completed a $3 million follow-on investment, acting as co-lead alongside Creative Ventures as part of Planet Watchers' $11 million Series A. With this round, Planet Watchers looks to invest in automation and to fuel the commercial growth of this business and expanding their sales efforts. So this next chart looks at the portfolio, focusing on the top 10 companies. First, let's look at the donuts on the left-hand side that paint a picture of the portfolio. So in terms of stage, you can see that Soonicorn, so these are businesses that we believe will become unicorns over the next 3 years. They represent 69% of the value versus 9% of the value for the listed companies. In terms of investment across the ecosystem, The data category represents over half, 53%. These are the satellite constellation businesses building this digital infrastructure in the sky. In terms of geography, we've got a broad spread. US accounts for 27%, UK 33%, and the EU 33%. So turning to the table on the right, the net asset value table, the top 10 companies accounted for 70% of NAV, with the balance of the other holdings where we believe there is considerable value at 13% of NAV, and with 17.5% held in cash to support the portfolio and continue to make limited new investments. Now, last quarter, for our full year results, I talked at length about the fact that the majority of the revenues across the portfolio came from defence and climate related customers, which collectively accounts for more than 90% of aggregate revenues in the private companies in the top 10 holdings. We sought to justify why the valuations have been robust, because these industries that we're serving have growing budgets that are uncorrelated with general market trends. We also provided a detailed breakdown of the methodology for our valuation process. Now, this quarter, I'm going to put a spotlight on how we structure transactions to protect against the downside. Next, I'm going to introduce my Seraphim partner and CIO, James Brugger. He's going to take us through a deep dive into the investment structure we routinely use to protect the downside value of the trust's assets. We hope that this exercise will provide a further understanding and thus confidence in our valuations, which have remained robust during 2022 against falling stock markets. So over to you, James.
Thanks very much, Mark. So going to talk through two different forms of downside protection that are common attributes of not just Seraphim's investments, but of the venture industry more broadly. So the first of those relates to preference shares and particular attributes of these preference shares. So what are preference shares? Well, in essence, they're a class of share that ranks senior to ordinary shares and other classes of shares. And critically, these preference shares typically have what's known as a liquidation preference. What a liquidation preference is it provides for a priority return for holders of those shares ahead of other classes of shares. So what's the purpose of having a liquidation preference? Ultimately, is to provide downside protection on the value of an investment in less positive outcomes. How does a liquidation preference work? Well, at a liquidity event, such as a business being sold, typically holders of preference shares are entitled to receive an amount that's normally equivalent to a 1x return, so effectively the money that they have invested into the business, ahead of any other proceeds being distributed to other shareholders. So you can think of this liquidation preference as essentially ranking junior to any debt that a business has, but senior to any other classes of shares that exist. So what does it do? Well, ultimately, and we'll talk through an example of this in a moment, what it does is to provide downside protection by potentially delivering a 1x return on investment in low exit scenarios, and scenarios potentially significantly below that of the entry price that has been paid to invest in a business. So Mark, if you turn to the next page, I'll talk through a worked example. So appreciate this chart is a little complex, so bear with me whilst I just try and talk you through what it's showing. So this is meant to be an illustrative worked example of the impact that having a liquidation preference might have. So this worked example is for an imagined round of £50 million invested into a business at a £200 million valuation. That 50 million is invested in a new class of preference shares that rank senior to all of the other classes of shares and that benefit from a liquidation preference equivalent to a 1x return. So what this chart shows, so along the horizontal axis is enterprise value across a whole range of different exit scenarios, ranging from very low values up to quite considerable outcomes. On the vertical axis, it's showing the return on investment for this particular round of investment as measured by a multiple of capital invested. So what this chart shows is that there is a very considerable range of outcomes from 250 million sterling, which was essentially the post-valuation of the imagined round, all the way down to 50 million sterling, and that in all of those scenarios, this liquidation preference would provide investors with an ability to get their money back, their one times return. If an exit was less than 50 million, 100% of proceeds would go to the holders of this class of share. And so you can see it's only above 250 million, where obviously the business is being exited at a higher value than the entry price, that investors are able to achieve more than a one-time return. So you can think about that there is a very significant margin between the enterprise value that has been paid to acquire this stake in the business, 250 million, and a very significant margin all the way down to a 50 million exit, where we would be able to, in this scenario, preserve a one-time return. Mark, onto the next slide. So the second form of downside protection that we wanted to talk through is something called anti-dilution. That is another typical characteristic of preference shares and of the venture market. So what is anti-dilution? Anti-dilution is essentially a mechanism that enables you to retrospectively adjust the price paid or the shares owned for a round of investment, where a subsequent round is done at a lower valuation than the preceding round. So this is what is commonly known as a down round. So what is the purpose of anti-dilution? So essentially, it helps protect the percentage ownership that you might have in an investment. How does it work? Well, as and when there's a down round, so there's a subsequent round of investment that's done at a lower share price than the round that we may have invested in, that's a trigger event that results in additional shares being issued to us, typically at par or at nil cost. So what does this do? Well, by getting additional shares issued to us, it essentially provides downside protection by reducing the amount of dilution that our investment will be taking as a consequence of the lower price round, thereby in helping us to preserve our ownership stake in businesses. Next slide, please, Mark. So just to help build on this, we've got another worked example of anti-dilution. Again, using this same imagined round of £50 million being invested at a 200 million valuation to acquire a 20% stake. So in this worked example, we've assumed that there is a subsequent round of a further 50 million that is done at half the share price of the round that we originally invested in. So this is a significant down round. So the chart on the left shows how anti-dilution would work in a scenario that we benefited from what's referred to as full ratchet anti-dilution. This is where you get 100% price adjustment through your protection. So on the chart on the left-hand column shows the proportion of shares that would have been purchased in the original round, 20% ownership. The middle column shows the impact of all of these additional anti-dilution shares that would be triggered as a consequence of the down round, effectively doubling the number of shares that were owned. And then the third column shows the impact of the additional shares that are issued to investors in the down round. So translating that into what it means from an ownership perspective, the right-hand chart shows three different scenarios, all based around this same worked example. The orange line is exactly what we've just talked about, where having full ratchet anti-dilution, where you have 100% price adjustment. So in that scenario, despite the fact that the next round is at half the share price and quite dilutive, ultimately the anti-dilution protection would mean that our stake would actually increase from 20% to about 25%. The middle line is probably one that is more reflective of the position of most forms of anti-dilution, with something that's called weighted average. This is where you get a proportion of adjustments. As modeled here, it's a 25% adjustment. And then the bottom line, the green one, is to show the difference of if you don't have anti-dilution protection. So you can see here that you're getting significant benefit in terms of preserving ownership through having anti-dilution. Next slide, please, Mark. Okay, so what does this mean for the Seraphim portfolio? So the table here is showing the private holdings within the top 10 companies. So what are the takeaways from this? So number one, in all of those private companies, we own equity. We don't own any convertible loan notes. The form of equity that we have in all of those holdings is these preference shares that I've just been describing. And as you can see, for all of the companies that are indicated here, we have some form of both liquidation preference to help us preserve the value of our investment in downside scenarios of low exits or falls in enterprise value. And we also have some form of anti-dilution to protect ourselves in a scenario that there are down rounds. Final column, just to explain what these numbers mean. This is essentially the percentage of our holding for each company that sits in the top rank of priority that I've just described. So you can see there's variability and differences between businesses, but overall a very significant proportion of the value of our top 10 holdings, which, as Mark indicated, represents the majority of NAV, benefit from being in the top rank, and all of them that are private benefit from having liquidation preference and anti-dilution protection. Next slide, Mark. Okay, so just one final slide to help you hopefully understand what this means in the context of valuations. So what this chart shows is across the top 10 companies on an anonymized basis, how much margin we have in terms of how far the current enterprise value that we are valuing each of our holdings on, how far it could reduce before it would start to impair value versus the cost of those investments. So you can see there on the left-hand side that in some instances, these liquidation preferences that I've talked about provide us with a margin for enterprise values to fall by up to 85% before, in theory, there would be any impairment against cost, and in some other businesses, a more modest amount. What does that mean at an overall portfolio level for the top 10? It means that on both a mean and median basis, we have in excess of 60% margin in terms of potential reduction in enterprise value before we would be impairing cost. And on a NAV weighted basis, it's still more than 50%. So on a NAV weighted basis, what that's showing is that valuations could effectively halve overall before we would be needing to impair against cost. So I appreciate that's quite a lot of complex concepts, but hopefully that has helped build a better understanding of the strength of the downside protections that we have, and as a consequence, the robustness of the valuations that we've published. Mark, over to you.
Thank you, James. And just to add a couple of points onto that to build on what James has said. So in this chart here, company H and I doesn't mean that these companies are in weak positions. In fact, company I is our best performing company. And the other thing to note is that James was talking about the valuation based around exit. But each quarter when we're doing our valuations, we effectively run a waterfall that takes into account the positions of the preference shares in order to determine the valuation. So moving on to our final slide before we take some questions, I'm going to talk about the market. So the quarter to the 30th of September witnessed clear evidence of the wider challenges in the global economy. They've really now started to manifest themselves in both the space tech sector and the broader venture capital market. So a muted exit environment, poorly performing public markets are now impacting the later stage or the private growth market. We've seen over the last quarter a steep drop off in both the volume and value in these later stage deals, but the actual activity remains fairly high in historical standards. It's really only the 2021 level that was the peak. They've gone back to sort of 2020 levels. So we've seen moderation in contrast to the excessive levels of 2021. Median valuations have remained robust, whereas mean valuations, and these are heavily influenced by outliers from very large funding rounds, they've dropped somewhat. So this is in contrast to the early stage market, which remains buoyant, both in terms of transactions and valuations, continuing in line with 2021's record-breaking levels. We're seeing the rounds becoming more investor-friendly. So the kind of terms, the downside protections that James was just talking about there are all included, and valuations are softening. But let me give you a public data point on that. PitchBook, which is a respected firm that covers this market, have identified that just 8% of deals that closed in North America in the period to Q3 2022 were down rounds. So this may well be a reflection of the record amount of capital that's raised by venture funds in recent years, but I also think it's a reflection of the type of downside protections that we've just highlighted to you. So this assessment of the wider venture ecosystem is consistent with our recent experience in space tech. Seraphim produces a quarterly report the Seraphim Space Index every quarter to show the public the amount of private investment in the space domain globally. So the index has showed record numbers of transactions have closed in Q3 2022. Year-to-date deal values are on par with 2021's record levels. Although the number of larger, later stage deals have dropped considerably in recent quarters, the early stage continues to see healthy levels of activity.